Stocks plunge, but why now? In today's video, we're going to look at everything that's been happening in the bond market, the stock market, and how that affects you directly. You came here for the truth, so let me unveil that for you. In today's video, we're going to begin with what's going on in the bond market and why this is historic. It's huge. Even if you're not investing in bonds or have no intention on doing so, these are the signals that you've got to pay attention to. Once we know that, we will know how to thrive and prosper. Sound good? Let's begin. Okay, the first thing I want to look at is that something is breaking in the financial markets. Here's what's behind the sell-off. And if you've been a viewer of the Money GPS for a while, you're already ahead of the game. But look at what CNBC is saying. Rates are expected to stay higher for longer, an idea the Fed officials have tried to get the market to accept, and which investors are only now beginning to absorb. Getting used to a more typical rate structure doesn't sound like such a terrible thing, but after 15 years of living in an unnaturally low rate regime, normal sounds, well, abnormal. All of this has to be assimilated and digested by the market. You can see that it's troubling and it's difficult. Oh, yeah, it is. When you're so used to this, when you've been told 100 times that rates would never go up again, then of course rates do go up. You're flabbergasted. You're dumbfounded. You're in a space where it's Alice in Wonderland. But the reality of the circumstances here on this channel were that it was going to happen. And yet, over and over again, we were told by everybody from top down, the Federal Reserve, the analysts, the YouTubers, they were all spitting the same message, but you want the truth, and that's why you're here. Let's go on. You can see seasonal weakness is pretty normal for the markets in September and October. Yes, absolutely. The threat to equities is more along the interest rate side. We really need to get through the bond sell-off and find some type of equilibrium in the bond market before we think stocks will find a bottom. The yields pose a major headwind to equities. That's right. Specifically, we'll talk about which equities are the most vulnerable. I'll give that to you at the end in the what can I do section. But you could see right here, you've got rates that have risen considerably. At least, in this last while, when we were at zero for so long, anything seems like a high number. When bond yields rise, stocks are less attractive. Gold as well. You might think, wait, when there's problems and gold is worth more, right? Well, not necessarily, because if you're an investor in one of these financial companies and you're looking at what you can do right now, I want to protect my wealth, but if I think that a bond is completely fail-safe, it's bulletproof, I can get 5% right now. So wouldn't I put my money there versus gold, which they say, well, I'm not going to get any yield from it. Yeah, I can protect my wealth, but I'm not going to get any yield. I need yield because I'm going to lose that on stocks. And so at the same time, you're seeing stocks being less attractive. What is the upside for stocks in the next 12 months? Some are saying, well, maybe not too much, right? It might go up, it might go down, but with the bond, I can make 5%. 5% higher, that's pretty good. So money is not necessarily just crashing out of the stock market and flowing into bonds, but some of that money is going there. That's what we're seeing right now. You got to be aware of that. It's so important. Okay? As interest rates rise, the US dollar may strengthen, okay? And so these are floating against other currencies and things, but you got to understand that that's what happens. When an interest rate rise, when they start to increase interest rates, generally it makes the currency stronger, and that's what we've seen overall with the US dollar. Higher, and by the way, that's real good for anybody earning US dollars when they're outside of the US, all right? I'll tell you right now. Love to see that. Higher rates are a big risk to, guess what? Growth stocks. So watch that. If you've got any growth stocks, these are the ones that take the hit first. So let me show you some more details right now as we look at this. Fasten your seatbelts. The standard deviation of the Dow Jones daily changes since 1896. So we're going way back. And October tends to be a month where you just get these big swings. But I wouldn't put too much into that. It doesn't necessarily mean anything. But you look at it back to 1896 and It's a matter of fact. 10-year and the 30-year Treasury yields rise to their highest level since 2007. So we know that this is historic. We are going to these levels right now where, of course, you're going to see some very big, moves. You're going to see a lot of hostility from investors, and certainly the volatility has risen. There's no question. How 10-year treasuries could produce 20% returns, according to UBS. Now that's something that, that would be shocking. Imagine 20, what would that do to the stock market? If you're going to get a treasury, which is supposedly seen as risk-free, and you're going to get 20%, what do you think would happen? Well, of course, you're going to get a lot of money flowing into those. And that, by the way, would reduce the need for another round of quantitative easing because the government can print a whole bunch of money, or I should say, do a lot of spending, and then they can issue bonds knowing that they're going to have buyers, but they have to do that at a very high rate. So it is a balancing act. Remember, they've got an investor, somebody who's willing to buy their bonds, buy their debt. You have to pay them back at an increasingly higher rate. And as long as you have new people coming in, it could be manageable. But what has happened for the last while is that government needs to take on an extreme amount of debt, and they use the Federal Reserve as the buyer of, I don't want to say last resort, but the buyer of first resort. All right. So that's what's been happening, and a change could occur in the near future. This is basically like a channel, and bonds had been, this is specifically the 10-year bond, and it was going down and down and down and down. But more recently, if you weren't aware of this, but a lot of these YouTubers were saying, no, not going to break the channel, not going to increase. You don't have to worry about that. And it did. And then it kept going, and then it kept going. And they said, don't worry, it's not going to go any higher. It's going to come back down. And it kept going and going and going. Okay? So we have to realize that trying to forecast in the way that these models or guesses, depending on who you're looking at, the way that's being done is truly flawed. So here at this channel, we use something called the money mirror method. Okay? Very different scenario. Banks are bracing for a recession as Treasury yields surge. So the banks are very concerned, and this is a big problem for them, as we've seen with SVB, as we've seen with all these other banks earlier on in 2023. They went under. They were invested at a time in which interest rates were way down, and now they're way higher, and now they have this big differential in between, their assets. They're trying to keep the depositors. How do you do that? You give them higher returns. They can't keep up with that. There's a very fundamental problem going on with banks right now. I am covering all of this. I am tracking it day to day. I am spending time every single day tracking what's happening with these banks. If you want to know more about this and you want to see these failures before they rise to the surface, simply hit that thumbs up button and subscribe to the channel so that I can bring you the latest and greatest. That's it. All right. This right here is like, if you want to know the latest details about what's happening inside of the stock market, you could see Seeking Alpha. Now, Seeking Alpha, you've probably seen some like free articles online. That's different. This is the paid version, which I have. It's the Seeking Alpha Premium. Their alpha picks, like just to give you a little bit of, I should say, a little bit of respect to them, that their alpha picks, you could see on the right-hand side, their portfolio, alpha picks 47%, while the market has returned 13% since they launched this back in 2022. So they've done very well. I got to give them credit where credit's due. If you're interested, the portal that I have, I looked into it just before I recorded this video, and it still shows the $50 off coupon. I guess they haven't started the new sale. So right now, still $50 off. Which is a great deal. Check it out if you want. There's a page there. You can see the details. Link in the description below. If you want to know about like what are the best stocks to choose, why choose them, what more details about the bond market, how that affects stocks, so on, link in description. Here we have it. You could see signs of stress in the Treasury market. Bond yields, this is what you got to know about bonds. Bond yields move inversely to prices. So rising yields means prices are falling. And it's very like upside down, it's counterintuitive, but that's the way it works. The rise in yields to their highest level since before the 2008 financial crisis have stirred up worries that more banks might fail, like SVB and Signature did back in March. I've been telling you this is a concern, but their whole theory was that no, we're not going in this direction. The yields are going to come down, but here we are. Here we are today. So I hope you get that through your head that we've got to start breaking out of this mold. We've got to expand our thinking. Like, where are you going to live in this box and you're going to be able to go on in the near future here? The world is changing fast. We need to thrive. We need to prosper. And I want you to be with me here, okay? Because that's what we're doing. We're tracking all of this and we're trying to make sure that you have the best information possible with no bias. That's not what we do here, all right? It's all about the info. Mortgage rates raced towards 8% after hitting a high not seen since late 2000, excuse me. And you could look at that. 8% on mortgages. This is going to crush people. They're not going to be able to afford these homes, but they're going to push themselves to the absolute limits. We know that. Consumers should be spending less. And yet, as they say right here, interest rates are up. Inflation remains high. Savings have shrunk. And the labor market is cooling, yet households are spending. All of these companies are increasing their prices. At the same time, they're talking about the fact that they don't have as many people walking through the door in some cases, depending on the type of business. I think overall, yes, you could have dollar value equivalent spending, but if you've increased your prices by 50%, it's not necessarily equal. So just be careful of how you're monitoring that. I've seen in many cases restaurants, for instance, dine in on restaurants down quite a bit. People don't want to throw 20%, 25% tips out there. I mean, it's just the way it goes. So, and then we have this last thing. Chipotle tests automation for burrito bowls and salads. I've never seen a company do this much. Like, they're doing more automation than all of the other companies, it seems. So what are they doing? They've got Chippy the robot making the chips. They've got the guacamole one. Now we have one for burrito bowls. This is obvious because they don't want to pay what is now, I think in many areas, $15 an hour, that minimum wage. And so certainly they are going for this. All the fast food restaurants are doing this. Yes, those are not glamorous jobs. They're still jobs. They're going to be gone. Robots are coming. So you see what's happening here. Oh, they're going to start laying off people? No worries, because they won't be hired back by the time things get better, because there are robots, there are automation, there are other technologies that are coming through that will be available whenever the cycle starts coming back up. So maybe that's 2024, 2025, when things start strengthening. And what happens here? People will not have that work. So you got to be prepared in advance. Knowing this information, knowing the direction it's going, yeah, you got to take action on this. So we'll talk about that right here. Okay. So you got to be aware that we are still in a tightening cycle. This is the most important factor. We are in a tightening cycle. They call it quantitative tightening. And so there's a lot to that, I understand. But quantitative tightening means that it's just harder for the stock market to do well. It's harder for businesses to do well during these times. So it's like fighting an uphill battle. Possible, more difficult. You got to understand, okay? Assets that do well in recessions are important. Look for that if you're an investor, but also you, business owner, or just in general, that the things that have done well in previous cycles are the ones we should be paying attention to. It would surprise you. It would surprise you when you look at some of these things, but understand that the basics, the essentials are going to be more valuable than something that's like, hey, this could be really great. It's a fantastic idea. Maybe at some point. That's, not the environment we want to be in right now. Okay, and then we got to cut our losses at this time. Where you see things that just didn't work out, it's okay. It's okay. Cut losses. What I said right here, shameful characters call that tax loss harvesting. Oh yeah. Look, you got to admit when you've lost, and that's okay. There's nothing wrong with that. Just take the L, take the loss, and just move on. Make it happen. Look, if you want to get this stuff sorted out, right over here, that's Compass, okay? Compass is this is what it looks like. This is your guide. This is where your financial journey begins. And so you go on here totally free, no email, there's no ads, there's nothing to sign up, it's no cost. You go in there, you start to get your financial circumstance in order, and you fix it right away. Let's deal with it. TheMoneyGPS.com. All right. And then the comment of the day. I spoke to a bank employee yesterday and they said that they were closing 4 cash branches. Many of them will do this. Well, thank you very much for your comment, by the way. Love all the comments I get. You will see more companies that are going to have to close locations. It's retail, it's banks. Many establishments are doing this. They are cutting costs, they are cutting real estate, and we see that everywhere. So we got to be prepared for ourselves. I hope that I was informing you of a current scenario. What does it actually mean? And then, of course, what we can do about it. If you appreciate this information, hit that thumbs up button. I appreciate you for being here, and I'll see you tomorrow. Take care.